You get your advanced assurance and it's hats in the air and you think you're good. You've got to go back again for your compliance statements. And I think they get more, well, as much scrutiny, certainly at that stage.
Hi, I'm delighted to be here with Steve Livingston, CEO of IP Tax Solutions. So Steve, it'd be great if you could do an intro, a bit about yourself and what IP Tax Solution does.
Sure. So yeah, IP Tax Solutions, we are tax advisors and accountancy advisors. Most of our clients, in fact, well, pretty much all are SEIS or EIS backed. I've always worked with fast growth companies and really advise them on their journey, not only with the kind of initial structuring, a lot like you do, Sam, around the SES and EIS, but also around kind of making sure you do all the right things after you get the funding. Because as we'll discuss on here, it's pretty complex, SES and EIS, and once you get the funding in, it's a case of making sure that you stay compliant, and it's helping companies through that process, as well as stuff like R&D tax credits, EMI share options, patent box, and your general sort of tax and accountancy support as well. So that's kind of where we fit in.
Amazing. Thanks for that story. You and I met, Steve, because we both are incredibly passionate about all things SEIS and EIS. For those that don't know, I'm Sam Simpson, CEO of FounderCatalyst. We provide SEIS, EIS advanced assurance, support with your legal paperwork to do a funding round, and we make introductions between our customers and potential sources of funding. So without any further ado, what we wanted to cover today is everybody's heard of SEIS and EIS, all of the amazing tax breaks, but the schemes, both SEIS and EIS, are incredibly brittle. Now, we won't take a step back and tell you all about the schemes. We've got another video for that, but we'll just focus on the kind of key issues we see once people have typically taken on investment, how the SEIS and EIS can get broken along the way. And it's worth mentioning at this point, Steve, I guess that just getting SEIS, EIS advanced assurance and then taking on investment in an SEIS, EIS compatible way isn't the end of the journey. It's kind of the start of the journey. You need to maintain within the rules, within all of the rules, and there are lots of them, for a period of 3 years following investment. And lots of people forget that. So easy to reorganize something and then find you've destroyed all of your investors' tax relief along the way. So, Steve, why don't you get started with our first kind of misstep to watch along the journey?
Sure. Yeah. So the first one we want to talk about was really about taking SEIS and EIS on the same day. So it's really about the timing of the issuing of the shares. And it's fairly well established, but still people don't realize that it's got to be SEIS first. You've got to do SEIS share issue, and then EIS can follow after. If you ever issue shares under EIS, you can't go back then do an SEIS issue. You are, it's basically stuffed at that point. So it's ideally what you do if a lot of companies will typically want to raise more than the SEIS allowance. So in that case, what you'd ordinarily do is, you can do the fundraiser in one go, but you want to make sure that you issue the SEIS shares first, and then ideally have maybe a day, and then do the EIS share issue afterwards. That way, there can be no kind of complaints or issues over whether you got it the right way around. And also, just on that point, it's about the cash coming in and the timings. I'm quite keen wherever possible. I know in the real world it's very difficult, but ideally, the cash comes into the company bank account and you issue the shares, again, SES first on that same day, and then the ES comes in. And you do that afterwards. What you don't want to do, obviously, is cash comes in very, very early, and maybe a matter of days and weeks go by, and then you issue the shares. The risk then is you've got a loan to equity conversion, which is not allowable under the rules unless you do an advanced subscription agreement, which Sam and I have our own personal views on. They do work if you do them correctly, but it adds an extra degree of risk. The other thing you don't want to do is to issue the shares and then the cash comes in later, because then there can be a mismatch, and HMRC could turn around and say, do you know what was that cash for? It was after the share issue. It can't be the same thing. And I've not advised on it, but I've seen that happen. And HMRC picked up on that, and they denied the actual relief for the investors on that. So in that case, the shares were issued, and then cash came in later on, and that caused a major ruckus because that particular company was flying. And although you can quantify the income tax loss for the angel investors, the capital gains tax free exit was, it could have been huge, that figure, and it was indeterminable at that point. So quite scary. So getting the timings right, absolutely key on SES and EIS. Anything to add on that, Sam? Does that cover that one?
Yeah, so I think it's relatively straightforward to manage in a first come, first serve round. If you've got an SEI, joint SEIS and EIS round, if you've got some investors using SEIS and others using EIS, it's easy to herd the cats, if you like. It's the phrase often used in funding rounds. It gets much more tricky if you've got kind of pro rata. So if somebody's investing £10,000, 5,000 under SEIS and then 5,000 under EIS, it's really easy for the investors to put the whole £10,000 in on day one. The problem with that is they've not just destroyed their own SEIS relief, they've done it for absolutely everybody in the funding round. So on FounderCatalyst, we're really paranoid here. We give lots of warnings to both founders and investors to say, don't transfer anything. And then the founder can manually say, right, everybody transfer your SEIS investment now. You can wait a day. And, the problem is some investors will transfer money early and some will, be on holiday and wait a few days. So you kind of get everybody to transfer the SEIS. You tell people not to transfer any EIS until you tell them so. And that just buys you a day or two in the middle to make sure you get all of the SEIS and then you transfer the EIS. Thankfully, we've not seen this go wrong on FounderCatalyst because we put lots of warnings and caveats, but yeah, it would be a nightmare. It's not catastrophic because, as I understand it, Steve, and hopefully you agree with this, if you transfer SEIS and EIS on the same day, actually everybody drops back to EIS. So you can still issue EIS shares, so you still get the CGT benefits. You just don't. You get 30% rather than 50% upfront. But yeah, it's still a bad day, and you're not giving the investors the tax relief that they're kind of hopeful. So the next one I wanted to cover was being out of time for SEIS and EIS. I mean, this covers both the schemes, but it tends to be much more of a problem for SEIS. And it's just being aware of the definition of when those under SEIS you get 3 years from the date you start to trade, and under EIS you get 7 years from the date of first sale, or 10 years if you're using KIC or knowledge intensive company. So yeah, and the problem here is the slight nuances between SEIS and EIS. So EIS, it's really straightforward. Everybody knows the date they make the first sale. It's the date you cut an invoice within your company. You should be able to find that in your books. And it's a really clear-cut definition of the date of first sale. So for EIS, you've got 7 years. That's really straightforward. For SEIS, it's a more nebulous term. It's the date you start to trade. And it's not really well defined in legislation, but thankfully HMRC give a really good example. So imagine you're opening a shop, you rent the premises, you put shelves up and you stack the shelves. At that point, you're not trading. As soon as you turn the sign on the front door from closed to open, you're trading at that point. Even if nobody buys anything or nobody enters your shop even for 6 months, you're still trading at the point you change that sign. Which seems fairly straightforward if you're running a shop. If you've got a SaaS platform, an e-commerce site, or whatever, it can be much more great. But you just need to bear in mind that the 3 year clock starts ticking as soon as you start to trade, rather than when you make your first sale. I don't know if you've seen any challenges with this one in practice. Sorry, Steve.
No, it's generally, it's fairly well trodden down there. I think you're right. I think the one of the things where there's often confusion is around, data incorporation versus trading, things like that, especially on the SES side of things. But no, it's and also, as you say, the data trading, there's no strict definition of it, which makes it more difficult. So you're right, we kind of rely on that HMRC kind of term of the shop. So there is a bit of uncertainty occasionally there, but no, I've no kind of war stories as such to tell on that. It tends to be okay.
Excellent. So filing an EIS one for an SEIS investment. Tell us about that one, Steve.
Yes, making sure you get your right compliance statement. So again, you've gone through the process, you've got your advanced assurance, you've got positive response from HMRC, you then get the cash in from the investors, you do your share issues in the correct order, and then further down the line, you've then got to it's not over. I think a lot of founders think, right, okay, so I've got my advanced assurance, fished my shares, got the cash in, I'm done. Well, you've got another step. You've got to go back to HMRC again, and you've got to get basically the tax certificates for the investors so they can claim the tax relief. There are specific forms. There's the SEIS1 form for SEIS, and there's also the EIS1 form for EIS. And you've got to make sure that you get the right ones in. So if you were to submit an EIS1 form where it's actually an SEIS investment, unfortunately, you can't pull it back as such. The rules are very, very strict. You've kind of inadvertently filed the wrong one. If by accident you say, please, it was just an admin error to HMRC, but they can't retract it. Once you've submitted the wrong one, unfortunately, that's it. And there was actually a case on this. It was X Wind Power or something it's called. And they basically did exactly this. They submitted an EIS1 form for an SES investment, and they couldn't go back and change it. And that's been well established. So making sure that you do the right forms is absolutely key. Again, it sounds kind of obvious, but I guess in reality, mistakes happen. But just double checking you're putting the right statement in for the right share issues.
Yeah, I think this is part of a broader problem, isn't it? The founders are delighted to get the investment cash in, and filing SHO ones and filing new articles with Companies House and doing this SEIS. It feels like the compliance process feels like a bit of a distraction, but it's absolutely vital to allow your investors to be able to claim. And thankfully it wasn't one of our customers, but I've seen this in practice. Somebody contacted us to speak about they'd misfiled an EIS one rather than an SEIS one. And I couldn't believe that HMRC wouldn't be more flexible, but actually it's defined in statute. It's in the Tax Act. It says that once you filed, you can't retract that. So HMRC aren't known for their flexibility. In this case, they're following the letter of the law, literally to the letter. So yeah, it's really frustrating. Again, it's not catastrophic. So your SEIS investor would benefit from the EIS tax relief, but again, it's that difference between 50 and 30%. And they're not getting the tax the tax relief that they thought they would, it's not a great way to start your kind of founder investor relationship, is it? So I think the next one's ridiculously straightforward and hopefully really quick, which is repaying a director's loan account using EIS. And again, this is a real nuance between SEIS and EIS. If you've just closed the funding round under SEIS and you've got, say, a £50,000 director's loan account, if you have authority to repay your loan account from investors, which is really unusual, by the way, most investors would be disappointed that you're taking 50 grand of their investment straight out of them. But sometimes it happens. Under SEIS, that's okay. You can repay a director's loan account immediately, and there aren't really any challenges with that. You just can't do it under EIS. It's that straightforward. It's one of those examples where if you repay your director's loan account using EIS, then you will destroy that EIS relief for that investor, which again is very disappointing. A really bad way to start that relationship. In practice, it's very rare for a founder to be able to repay their director's loan account. It's pretty unusual, but just be aware of that nuance between SEIS and EIS. I don't know, Steve, seen that one in practice, or if it's
seen it, as you say, rare that it actually comes out to play, but it's one just to be absolutely aware of because it can come and bite you. But yeah, it tends to be rare. And I think probably the next one is also kind of the nuance between SES and EIS, and it's about this issue of being under control. So for both SES and EIS, you've got to be an independent company. So always think of it as kind of you're the top company in the scenario. You are the one raising the investment, issuing the shares under SES and EIS. So you've got to be independent, not under the control of another company. Now, there's slightly different rules on this. So for SES, you can never have been under the control of another company. And there's a slight kind of, again, nuance here. And I don't know if you remember this, Sam, but I can't remember the rules, actually, the legislation changed, but there was something about often for formation agents, or certainly some law firms, they will have off-the-shelf companies ready for new companies. So kind of, XYZ Limited, they're good to go. They're just dormant companies they're going to use for future clients where they want to have a new company. And there was a real worry about those, whereas because they were under the control of the law firm or whoever set them up, or the registrar, would that then jeopardize the SEIS relief in that case? because they were at some stage under control of the company. And HMRC came out and said, it's okay. That's the one scenario where you're okay. That's the one exception. It was just that initial kind of inception of the company. Beyond that, if it's ever under the control of the company, so if the directors, the shareholders, you have a company up and running and you've got basically a subsidiary company of some form, you can't then get SES in that company. You can't then change the shares afterwards. However, for EIS, it's more flexibility. You can be under the control previously, but as long as just before the date of issue of the EIS shares, you amend it such that it is an independent company, then you can be okay. And you can go ahead and get EIS on in that scenario. So as long as you're independent at that point, that's fine. And you can have been under control of another company before, not under SEIS. Is that your experience, Sam?
Yeah, I've seen this one in practice where the existing founders have existing companies that they contract for or consult via. They create a new co, and they don't own the shares directly as founders. They own the shares via their existing companies. And yeah, there's no way to put that genie back in the bottle. For SEIS, under EIS, as you say, you just move the shares to the individuals, and everybody's happy. Under SEIS, though, that business will never be eligible for SEIS. So seen that one a few times in practice, and yeah, it's painful. I mean, sometimes they just go and create another new co with themselves as founders, and as long as they don't trip over the continuing trade rule, I think that one's that's probably the best way of resolving that issue.
Yeah. I had a similar one just in the other direction as well once where what was it for? It was EIS, I think it was. And in that case, the relevant company had a minority. It had, I think, about 48% in a subsidiary company. So it had 48% of the shares in a subsid. So it was coming up to the time of the EIS, and we're like, no, you've got to sort that out. You've got to actually get above 50%. Be to be able to have to make sure you don't jeopardize the rules, because as I say, under SES and EIS, you can't have any minority interest. Anything less than 50% in another company, any sort of say less 50%, 50% or less, then you can't get either relief. So in that particular case, it was a difficult discussion with the other company, this kind of minority interest, and they upped it to just over 50 just before the EIS, and got that through.
Yeah, and there's a theme here. I know we're going to cover share classes in a little bit, but founders sometimes like to overcomplicate matters. They like having group parent companies and subsidiaries. They love different share classes and things. I mean, there is a motto that we tell all of our customers, which is keep it simple. Ordinary shares for everybody if you possibly can. Single company, no subsidiaries or anything like that. And it's just really easy to break SEIS and EIS in new and novel ways. And as we said at the start, it's not just about the state of your company when you incorporate it and when you take on funding. It's for the 3 years after that as well. You've got to remain compliant. So, and the schemes are so brittle, it just makes sense to keep everything as straightforward as you possibly can without introducing unnecessary. Investors don't like that unnecessary complexity as well. They want a really straightforward vehicle to invest in with straightforward share classes.
And do you know what? One further point you made me think about that is, if I said you've got to have over 50% in a subsidiary company. However, if the subsidiary company is going to be using the SES or EIS cash, it's got to be a 90% subsidiary or more. So making sure that you get that right. So if you've got a holding company scenario and you're going to use a trading company beneath it as a subsidiary, it's got to be at least 90% owned in that case to use the cash, the SES or EIS cash. See, this is the thing, isn't it? So many rules. This is part of the problem.
Yes, I think the one exception to the no subsidiary kind of guidance would be for foreign companies. Sometimes you need a subsidiary, in China or America or whatever for local taxation reasons or whatever. That's a pretty good reason to create a subsidiary in a different geography. And in that case, I would always make it just a wholly owned subsidiary, so you don't fall foul potentially of that kind of 90% rule or anything like that. What I wanted to cover next is my least favourite instrument, the ASA, and similar things. Within the UK, you've probably heard of things like convertible loan notes and safes and warrants and options and all of those kind of things. None of those instruments are in any way compatible with SEIS, EIS. You just can't use them. The exception to that is the ASA, or Advanced Subscription Agreement. that allows an investor to put cash in at one point, and really the only benefit to an ASA is you get to defer the valuation until kind of a full price round usually. I'm not a great fan of ASAs. I've got an article explaining exactly why that I'll put in the comments. There is one challenge, and this makes ASAs even less useful than they otherwise would be. So HMRC have released guidance on this, and an ASA must have a long stop date of a maximum of 6 months. So that means technically when you put your money in at the start of an ASA, you don't own any equity, which for me is part of the problem as an investor. But your ASA must convert into equity. The interim must convert into equity within 6 months. Otherwise, it's outside of the HMRC rules, and any investment under the ASA won't benefit from the SEIS and EIS scheme. Now, if your investor's not investing under SEIS or EIS, it doesn't matter, and you can have a 3-year long stop date. It doesn't really matter. But if they are, then it must be a maximum of 6 months. And I'm sure, well, both of us have seen this one go wrong, Steve.
Yeah, it's one of those things. I share your sort of like discomfort with ASAs. It's one of those things I was, to the point you made earlier. SES and EIS are very, very complicated in their own right, and you're just adding an extra degree of risk to it. And if you can avoid it, I would. Some scenarios, it's just you just have to do it, and you just make sure you go through all the boxes. And I think the advance assurance application, try and get the ASA in with it if possible, so that you can get at least HMRC to cast their eye over it and make sure they're satisfied and happy, ideally. Again, it just helps mitigate that risk a bit. But yeah, I'm not a big fan. But the thing is, as again, you've probably seen Sam, is especially from a US perspective, they're very popular, the kind of safe type route. So I think over here we tend to obviously follow things the way the US goes, and I think increasingly people read about them and want to do it. So we may see them gaining popularity. I'm not sure, but yeah, I'm at this stage I'm not a huge fan, but they have their place. Yeah, we can talk about selling the company within 3 years, which can happen, very rare, for the reasons I say about SES and EIS, and it's making sure that, as we said earlier, once you've issued the shares, you've got the 3 years afterwards, and that keeps extending as you do more and more rounds. So being careful about that. So typically, you've got to stay compliant as a company for 3 years. And that means you can't exit as such. Now, if you were to exit, then you're going to jeopardize the relief if you exit before the 3 years is up. I have actually had this happen in practice a number of years ago. It was got a predate SES. It was an EIS scenario. In that case, it was only 2 business angels, I think, so it was easier to discuss. Basically what happened is the company just out the gates was flying, and an approach was made. They made them a serious offer. I think it was a PLC actually made them a serious offer, and it was just a case of sitting down and crunching the numbers, and they worked out that okay, they're going to lose the EIS tax relief for the investors if they sat down with the investors, crunched the numbers, and said, listen, it still works out great. It was worth, in that case, the EIS investors losing their income tax relief and obviously capital gains tax benefits for this particular offer, because it may not have come around again. So it can happen. It's the only one I've ever seen. So typically companies will go beyond the 3 years. So I don't know if you've seen it. Have you had any cases of that at all, Sam, in your experience?
I've got 31 investments myself, so I've been investing for the last 6 years. And one of my, it was a gaming company who, they were trying to exit after, and it was frustratingly close. It was 2 years and 10 months. That was due to be the transaction date. And there's a dynamic when you come to when a business is looking to exit. So one of the very, very standard market standard terms in the documentation is something called drag along. And drag along effectively gives the founders, as long as they hold a certain percentage of shares, it gives a dragging majority the ability to sell a business without everybody agreeing to it. So in theory, the founders could have sold the company because they had more than 75% ownership. They could have what's called dragged me through the transaction. And that would have destroyed my EIS relief, as was in that case. It's a ridiculously rare scenario because actually, most startups exit, 7, 8, or even more years. So this is pretty unusual. But in this case, they were going to exit within the 3 years. That would have destroyed, as you say, my upfront tax relief. So I'd have had to pay back my £15,000 or whatever I'd have, and I'd have to pay full capital gains tax on the increase in value. So that would have been painful and would have cost me £50,000 or so. I think I calculated it as. In reality, the transaction dragged. It went over the 3 years, and everybody could benefit from their tax relief. But yeah, so it's an interesting scenario. So and this all comes back to the rule we spoke about earlier, where you need to remain compliant for the rules for at least 3 years, and you need to have held the shares as an investor for at least those 3 years. Any premature sale, you lose all of those tax relief. So the next one is around creating a preference. I alluded to this earlier. So our very strong guidance to founders is to keep ordinary shares for everybody. So founders, investors, advisors, no matter who it is, just give people ordinary shares. Because this is an area we've seen people trip up quite often, where you inadvertently, either when you're creating different share classes or when you reorganize share classes, you create a preference, usually referred to as a liquidation preference. And this means that the owners of a specific share class, in the event of an exit or in the event of a liquidation of the company, they get financial benefit before other shareholders. HMRC deem that under SEIS and EIS, those schemes are meant to be the only way you de-risk your investment. And actually having a liquidation preference as an investor would give you a benefit over those other shareholders. So that is, black and white. It's absolutely clear that is not allowed. And it's like I say, it's not just when you create the share classes, but people reorganizing within that 3-year period need to just make sure that you don't create that accidental preference. And I'm guessing you must have seen this one in practice as well, Steve. This is actually quite easy to get wrong, isn't it?
Yeah, absolutely. It's one of those, and I'm with you. If you can just do just ordinary shares, just keep it simple. I have discussions with clients where it's kind of they've read about it and they want to do EB, A, B, C, D, E. They want all these different classes of shares, and I say it's kind of they want a Ferrari. When you want to kind of just start off, you just start off with a Ford Fiesta, kind of get it very plain, vanilla, simple. You can do all that in your next round. That when you're going to get your sort of formal VCs in private equity funds, they will be all over it trying to make the changes. And as I say, taking care when they make changes, absolutely. And the other thing is just as you alluded to, is the 3 years as well. Things as well as the obvious things where like another round comes in and people are messing around with the share classes. You need to be really careful there. There can be also sort of more kind of subtle or less obvious things like share options. So if you create another class of shares for maybe the employees for EMI share options or something, and you have some sort of restrictions on those shares, then just being careful you're not by default, by accident, making the investor SES and EIS shareholders or share class preferential. So it's just being careful around that you don't make a mess of it. It's so easy to do. So just taking care. But it's a hot issue, definitely.
There is another. So in our standard FounderCatalyst paperwork, which is based upon the BVCA paperwork, there is, it just assumes ordinary shares, but there is another class of share called deferred shares, which are used in some kind of reverse vesting when people leave early. And we've been paranoid on our paperwork to make sure that those deferred shares take the first penny on an exit or whatever, so that they don't have so that ordinary shares don't have a preference over the deferred shares as well. So any scenario where you have anything other than ordinary shares. And then, as you alluded to earlier, when you have VCs or institutional investors coming in, typically they will take a liquidation preference themselves. So they will have preferred shares or A ordinaries or whatever. That's okay, because the A ordinaries that the VCs would own would have the preference. It's not the ordinary shares that SEIS investors would have. So whether you like the kind of commercial arrangement is one thing or not, but that kind of scenario is usually fairly standard, and doesn't create a preference for those kind of ordinary shareholders.
And being aware that HMRC are hot on this as well, because again, I was speaking to a client. Say a client, I didn't advise them on this, fortunately, but they had it was a live issue for them right now. They amended their articles. Again, some investors came in, they played around the share classes, and they basically filed the new account. So filed the revised articles, and they were the wrong ones. That I'm not sure if they were a draft or basically there was something that did create a preference, and they put in their EIS one, and HMRC picked up on it and were denying it. And they wouldn't get it. And these were big figures as well. So you've got to be so careful with it. It's a really tricky area. Yeah.
And what's interesting there is, you could say, well, how are HMRC going to find out? Well, firstly, they'll look at Companies House and see what your up-to-date articles are, I'm sure, and they can look at those themselves. But also, when you're filing your SEIS one or EIS one, they ask for a copy of your latest articles that have been adopted as part of the funding round. And I know, they've asked some queries, thankfully without a challenge, but they've asked some queries on that, on the articles to make sure that they're comfortable. So I know for certain that they do look into those articles. And even though the articles are a 40-page document, they ask to be pointed to where those preferences could occur, and they will go and look at those documents. So.
And that comes back to that point, doesn't it? About you get your advance assurance and it's hats in the air, and you think you're good. You've got to go back again for your compliance statements, and I think they get as much scrutiny certainly at that stage, because for a lot of companies, they've had a period of time between the advance assurance and going through all the process of issuing the shares, etc., and stuff can go wrong in that. So HMRC are quite happy to have a proper good look at that stage. So I think, don't think you're necessarily out of the woods when you get your advance assurance. You've got that kind of second stage to go back on, and making sure that you've just dotted every I, crossed every T to make sure you're good at that stage. Yeah. The next one was about the spending the money. That's right, we're going to talk about. So making sure that, again, this isn't usually a problem for a lot of startups, but there are rules around using the cash up or basically spending the money that you've raised. So under SES, you've got 3 years to spend the money, and under EIS, you've got 2 years. Say to spend the money. The wording's slightly different, but basically to have used up the cash. And it can get complicated here, especially as we've already alluded to. A lot of companies will do SES and EIS to make sure they get the relevant limits they need in terms of fundraise. So making sure that you've got that audit trail to be able to demonstrate that you have spent the relevant money, and you can make it so you've got SES with one rule for the 3 years, EIS for 2 years, and then you imagine you during the course of that time you then become you have revenues and you've got trading income. You've got that as well to take into account. So which money's being spent where, and being able to track it. Now, ordinarily, you'd have done obviously a business plan, which you probably sent with your advance assurance. You've got an idea from the cash flow forecast of where the cash is going to go and how you're going to spend it. Sometimes, we see companies will have separate bank accounts to be able to show, where that they are spending the money within the relevant periods. But you would think it's something straightforward, as spending the money is quite easy, and it generally is for a lot of companies. 2 years isn't normally a problem. But for larger fund rounds, then you've got to make sure that you have got the use case, and you are actually going to spend the money on the right things as well, exclusively for the relevant trade that your business is in. So again, I've never actually had a practical problem with this one in reality, but it is there. I know, Sam, if you've seen any actual situations where it's come to bear.
I've not. No, I've not seen this one in the wild.
Funny that.
Yeah, yeah. Everybody spends the money. I mean, to be belts and braces and paranoid on this, it would kind of make sense to have 3 bank accounts, I suspect, where you put the SEIS into one, the EIS into investment into another, and you can prove you've spent the money from each of those bank accounts on qualifying activities. And then a third kind of day-to-day bank account because within a couple of years, businesses may be revenue generating, and then how do you prove that you spent the SEIS money when you're generating profits potentially? It's a really so it kind of makes sense to split. I don't know anybody that does that, by the way, but that would be the kind of belts and braces way, I think, to be.
It's one of those. Again, it's not many do actually do that. And I think one of the things, I suppose, that the argument against doing that is you've got nowhere to hide. You kind of, in the sense of you're putting your buckets separately, so you've got to make sure you get it right. Whereas if it's in one account, you can try and make the argument and point to how you have done it correctly. So there's not necessarily a right answer on that. As I say, it's one of those. I think for a very large fund round, it's more of an issue. For most companies, startups, they tend to burn through it pretty quickly. So, but yeah, it's one to be aware of for sure, isn't it?
Yeah, and this is related to a similar problem that we didn't have on the list to discuss today, but let's throw it on the table anyway. The gross asset test um, challenge as well, and I think to use an example where somebody's doing an SEIS, an EIS, and an institutional investor at the same time. I think we've all seen this one. And the institutional investor puts their £500,000 in on day one, and then you try and do SEIS and EIS. And for EIS, that in that scenario, it should be okay. But under SEIS, there's a gross asset test. So by putting in the £500,000, you've actually meant that you can't take on your SEI investment because you're above the prescribed limit for that gross asset. I've seen that one in practice, and it's really, really painful. So I think the only way of doing that is getting your timings correct on a funding round, which is do your SEIS first, wait a day, do your EIS, wait another day, and then have institutional investors coming in. I'm guessing you've seen that one. It's fairly easy to trip over.
I have, yeah, I have 100%. Yeah. And as you say, that's where you've got to manage it and maybe and speak to them about it. It's one of those, if you're working with lawyers, make sure the lawyers are aware of it. Most will be, you hope, but not every lawyer is going to be completely savvy on the SES rules, etc. So making sure that, yeah, you get the timing right. I've seen it happen, and it was a nightmare to try and sort out. And that's the thing. Often, the banks, they're probably more relaxed about you writing the check and getting it out to you. Just get it off the desk. When they're getting the cash out of investors, it probably takes a little more time. But it's one of those. It's very easy to do, and they're just like, oh, well, just it's a Friday. We're just going to get it out the door and get it done. And suddenly, yeah, you've just like scooped it. And even if it's, it could be a loan situation. Sometimes, you think being careful on this. From an accounting perspective, you say, well, it doesn't matter because you've got the cash in, but I've got a loan, so they cancel out to nothing. But it's not; it's gross assets. You only look at the top half. You're not deducting your liabilities on this. You're looking at your gross assets at that point. So any cash you've got, stock, fixed assets, debtors, anything you've got to top them all up. But you're right. It's usually the matched kind of funding or bank funding that you're getting in that's the problem one here.
Ouch! I hadn't even considered the implications of the loan. That's really interesting because you'd naturally think they kind of net off, don't they? But yeah, that doesn't work that way. So yeah.
Doesn't work. Yeah, you can't deduct your liabilities. Yeah.
Amazing. So I think the last item we wanted to discuss today, this is our 10th, is around an EIS investor, and again a nuance of the SEIS and EIS schemes. This doesn't apply to SEIS; it only applies to EIS. But if an investor has invested in a business under a non-tax relief scheme, so they've invested without SEIS and just put money in, even for just a couple of shares, it doesn't. HMRC don't really care whether you just put a £5 in. But if they've made an equity investment outside of those schemes, then you can never go back and make use of EIS. And I guess the rationale is you've invested, you thought the investment was good enough in the first place to not make use of SEIS and EIS, and therefore you should never be able to make use of EIS. It's a really odd one though, because it doesn't, like I say, it doesn't count for SEIS. So you can be a non-SEIS investor and then invest under SEIS. That's fine. You just can't do it for EIS. Really esoteric. I don't know if you've seen that one in the wild.
Well, not so much, but it's interesting. It makes me think about the kind of the director or the director, non-director. So as in, for EIS, you can't have been a director before the share issue, before the investment. Whereas SES, you can, as long as you're a director. Can't be an employee, you must be a director. But you got the difference there from between SES and EIS. But no, I haven't actually had that situation come up as such. But it just throws up those problems again, doesn't it? Really.
Yeah, and you touch on we'll draw this to a close in a moment, but I think you just raised a really interesting point. I think one of the most elegant use cases for SEIS specifically is to bring additional directors into the business because they can invest in the business under SEIS as long as they're investing a suitable amount. And there's some interesting challenges from HMRC in this area. But if they're investing a couple of £1,000, something that can be meaningfully used by the business, as long as they're not an employee or a director already, sometimes under SEIS they can be a director already, actually, but they can invest in your own business under the SEIS scheme. And that's something I did. So I started an IT company in 2013. Me and my co-founders all invested using SEIS specifically, which was great. We all put £20,000 in, which gave some kind of working capital to the business. But when I exited in 2017, and it genuinely saved me and my co-founders millions in capital gains tax by using that SEIS scheme. So it's a really lovely way of incentivizing, co-founders, advisors, NEDs, and people like that. It's a great way of getting shares into their hands that benefit from CGT exemption on an exit scenario.
100%. And that's what it's all about, wasn't it? That's why, it's again, there was that whole thing around the directors thing for EIS. It was, and there was a quite important statement made about it back in the day where it's saying the crucial thing is it's not just about the cash. It's also bringing that expertise to the table. These kind of fledgling early stage companies want experience, and if you can bring that to the table, okay, you bring your cash, and you get your SES and or EIS, but it's also getting the right people in the right seats and then trying to help those businesses grow and bring that wealth of experience to bear, to help those companies. And this is a great sweetener on top of that, isn't it? It works really well.
Yeah, I think so. The thing to be mindful of and careful of, I know there's been a tax tribunal case on this, so it's an interesting one. But you've got to make the investment a meaningful amount of money. So you can't invest a pound to get 20% of the business, because HMRC they would argue 2 points. Firstly, the cost of executing the funding round would exceed the pound. And FounderCatalyst is great value at 1495, but we're still more than a pound, unfortunately. But the second thing, you've got to, the amount being invested has to be meaningful to the business. It's got to be able to kind of advance the business's purpose. Whereas if you're just taking on £50, then that would HMRC would reasonably challenge that, unless it's part of a bigger funding round. So if you can prove to HMRC, you're raising £200,000 and you're taking £100 for a director up front or whatever, then they should be able to make use of SEIS, because actually the funding round in aggregate is sufficient. And I've never seen this challenge, but you can have varying valuations and discounts to shares as part of a funding round. So I think I would feel comfortable, and this isn't advice, but I would feel comfortable doing having an advisor up front where you're giving them a 95% discount on the valuation, as long as they're followed by proper arm's length investors with investing a meaningful amount of money. I've never seen that challenged.
No, exactly. No, I think, and it links back to the risk to capital, doesn't it? And the kind of intention to grow the company. So, HMC will want to see that you've got a plan for this, that you're going to raise, as you say, a meaningful amount of money to get to where you want to get to. They can smell a rat where they think it's something where it's just a bit of a wheeze to get into the scheme. So, you've got to have some sort of business plan. They'll want to know what you're looking to do. And as I say, I always say at HMC, they want to see what I call a full fat company. They want to see you looking to build a brand. They want to see you take on employees. They want to see you looking to, potentially build a world beating company. They don't want to see a kind of a light touch, kind of lifestyle type company where you're going to sort of, mitigate all risks. You're going to take on freelancers, subcontractors. It's kind of doesn't feel like a full fat company. That's not what it's there to support. They want to see risk. They want to see intentions to grow. And that's where it kind of links into what you're saying. I think they're about, as long as it's part of a bigger round. And yeah, I don't think HMRC have any problem in people coming in on different terms. It depends your negotiation skills as a founder, what share price you get per person. They don't get interested in that. As long as it's arm's length and you're not linked to them in some way, then it should be fine in terms of what sort of level you come in at. But yeah, I think it's making sure that it's a genuine amount that's going to grow the company to something significant. And on that case, I had an interesting one once where it was an advanced assurance application. Just to go to show, you've got to be careful. The business plan we put in, initially they came back and denied the advanced assurance, saying that the business plan wasn't stretching enough. They didn't think it was sufficiently ambitious. And I kind of at that point thought, you know what, this could be the point where I have to close the doors on my involvement in this, when you've got people sat, civil servants deciding on whether something is sufficiently ambitious. Fortunately, went back and said, to be fair, the company said, listen, that was our safest kind of plan, but we've got another one where we want to, if we could really like a stretch type one. So they had that immediately to hand, so we fired that into them, and then actually interestingly, another inspector came back, they got passed on, and it allowed it. We went through fine, but they are, they are wanting to see, having a proper plan as such in terms of growth, ambition. That's what it's there for.
I'm not going to put you on the spot now, and I think we've spoken quite enough on this video. But we should do another video on, what is genuine growth company, capital at risk, use of funds. Those are the, those are the kind of things that HMRC look for in every advance assurance application, as well as, what are your sources of revenue and what are your costs. They're really interested in are you just going to outsource all of the development at no risk, and then you don't, you're not. There's no genuine capital at risk. So that is going to be another video for sure.
And that's kind of hot around television, film production, because they kind of got accidentally brought into the kind of realm of this and perhaps were slightly abused in some places. But unfortunately, there are genuine use cases there where, to think about how you can to make sure you follow in the rules, slightly different rules, slightly tighter interpretations there. But there's tons to talk about there as well, for sure.
Amazing. Well, we shall save that for another video. It's been a genuine pleasure talking today and shining a light on some of the kind of grey areas, I think, in the SEIS and EIS rules.
Brilliant. No, thanks for inviting me. It's been great.
Thanks, Steve.